Good afternoon, everyone. My name is Evan Bradley, and I'm the Chief Financial Officer for Campbell Property Management and one of the 5 owners of the company. I'm also a licensed CAM, and I work very closely with some of our largest clients facing major issues in their associations. For those of you not as familiar with Campbell, we've been in business since 1953 and manage over 400 HOA and condo association clients from Dade to St. Lucie counties here in South Florida. Our guest speaker today is going to be Paul Mack. He is a named partner of the firm Mack Mack Waltz. He is an excellent condominium and HOA insurance broker. We have the privilege of working with Paul for many years, and he services many Campbell accounts. So, Paul, do you want to introduce yourself a little bit?
Yeah, thanks, Evan. Mack Mack Waltz Insurance, really, we specialize in doing community association business. A couple of years ago, we merged our firm in with a larger firm known as Assured Partners. So we have over 3,000 communities in Florida that we insure. So I look forward to our discussion today.
Thanks, Paul. So just a quick reminder, this is for informational purposes only. This is not legal management or insurance advice. If you have questions about your specific situation, your specific community, please reach out to your broker, your association attorney, or your management company. Please do try to take advantage of the Q&A, but we need to limit it to questions about the course material. Again, questions about your individual situation are going to be beyond the scope of what we're talking about today. So with that, quickly get into Paul's bio here, and here's his contact information in case you need that. And we'll put this back up at the end. And let's get into our agenda. So we're going to cover a little bit about the basics of association insurance, the state of the current market, what we can expect for 2022 and early 2023 renewals, what, if anything, can be done to reduce these rates, and how to communicate and plan for increases. And if we have any time at the end, we'll take some of your questions. So first off, let's start off with how association insurance works. This is a little bit different from your normal vendors and your normal vendor relationship. So Paul, can you explain to us kind of what is the role of an insurance agent? What is the role of a broker, and how does this vendor relationship work?
Yeah. So like you said, it is a very different relationship than many other vendors that a community association deals with. So I think the first thing that everybody needs to understand is that the insurance agent doesn't set the pricing, the insurance company does. So your agent's job is to help you navigate through the coverages, explain it, recommend what you should buy, and help you choose the right program for your community.
So a lot of people say, well, how do I know I'm getting the best deal, or how do I know that I'm getting all of the the pricing that's available to me? How does that work?
Right. So everybody wants to make sure that they're getting the best deal, and that's where there's a big difference between other vendors and insurance, because the insurance companies will only deal with one insurance agent at a time. So many communities think that if they go out and they engage 3 or 4 insurance agents, that they're going to receive 3 or 4 bids. And because Florida is a very unique market and there aren't a whole lot of carriers that will participate, especially in this market, then what happens is it works as to your disadvantage, because all of us agents are going to the same insurance companies. So it's important to understand that the insurance companies will only deal with one insurance agent at a time. Choosing the right insurance agent that's going to be very thorough and go to all the insurance companies and then bring you back a comprehensive proposal that has hopefully many insurance companies to choose from, then that agent has done a good job bringing the best possible deal to the table.
So a common question we get is, what insurance must we carry as an association? It's a common one.
Yeah. So there's a handful of kind of standard or traditional insurance that an association will need. So even if we're talking about condo or HOA, it's still basically the same. So every community is going to need property insurance. So they're going to need to cover the improvements that the association has. If it's a condo and it has lots of buildings, then obviously there's a lot of property insurance, and that's probably going to be the most costly. If it's an HOA, perhaps they have a clubhouse and some sports courts and some other improvements. Well, those are going to have to be insured against fire and lightning and windstorm. So property insurance is usually the biggest one. Then we're going to need liability insurance, general liability insurance, because there's lots of common area. Elevators, catwalks, parking lots, clubhouses, pool areas. If somebody trips and falls, then they could sue the association. A liability policy protects the association from those lawsuits. It also hires a lawyer to defend them if they do get sued. We also have directors and officers insurance. That differs from liability insurance because the directors have a fiduciary obligation, and they make a lot of decisions, which vendors to choose, how to spend the money. And it's basically management malpractice for a simple explanation of what it is. So they all need management liability. We have crime or fidelity insurance. Condo and HOA law says that if you collect assessment money or special assessment money, that has to be bonded in case it's stolen from a third party or somebody on the inside. And then we also have an umbrella policy that covers over and above, because those policies that we spoke about, general liability and directors insurance, their obligation usually ends after about $1 million. So that's not enough today. So we have to buy an umbrella policy to provide, God forbid, we have a catastrophe. And then there's workman's comp, and perhaps legal gap insurance, and those are good coverages for the association to buy as well.
So some people with these rising rates have said, can we self-insure? Is that allowed?
Yeah, that comes up a lot, especially with these rising rates. But I don't have any that have talked about it. But the big reason why it's not feasible is because you have a high amount of assets. If you take a condominium building that has tens of millions of dollars in insured property values, those unit owners that are going to buy in there some of them are going to need a mortgage, and a lender will not recognize any kind of self-insurance. And it's not feasible in the sense that all those assets are clustered in one area, and one hurricane can do a significant amount of damage. So it's kind of hard to spread out that risk and make any kind of sense. Also, the bylaws are going to require that you buy insurance, and you don't want to go against what the bylaws say, because then if there's a loss and you're not insured, those directors made a bad decision, and D&O doesn't cover that either, the management liability. So creates a lot of exposure, and it's just not feasible from the standpoint of insurers.
Yeah, and most association documents I've read, like you said, require the insurance to be placed with an insurance company, and then you could be personally liable, as a director if you go against that, like you said. So absolutely, you need to carry proper insurance through insurance companies. So another term that we hear all the time, I think causes confusion for people, is the insurance carriers that are writing this coverage are admitted or non-admitted. A lot of people ask about that. What do those two terms mean when you're evaluating insurance companies?
So an admitted carrier has a higher degree of regulation than a non-admitted carrier, and non-admitted carriers are okay, and especially here in Florida. So just a little bit of quick background on what's going on here right now. We just have a very limited capacity available in the marketplace, and that's due to a lot of reasons, which I know we're going to get into. But we don't have a lot of carriers on an admitted basis that are writing. They have a higher degree of regulation, and if they are to go bankrupt, they're protected by the guarantee fund. So, and we've had a few carriers that have been liquidated by the state because they just don't have sufficient assets to be writing insurance. So the higher degree of regulation, if they want to raise rates, if they want to put exclusions on their policies, all that has to be approved by the Department of Insurance. It gives the policyholder a higher degree of regulation, and also if they go bankrupt, they are protected by the Florida FIGA, Florida Insurance Guarantee Association. And non-admitted carriers, there's a place for them here because there's not a whole lot of admitted carriers. And when there aren't, we got to go non-admitted. So the concept there is, well, those carriers are filling a need in the market that we don't have. So the insurance regulators have to understand that and lax their regulations so that we have some carriers that will participate in the market. Because if we had to rely solely on admitted carriers, we'd be in more trouble than we already are in.
Right. So I think this is a reason a lot of people are here with us today. Kind of why are we seeing such big increases? I'm sure a lot of people on this call have seen 20, 30, 40, 50% increases. And why are they so large? What's happening out there? What's causing this?
Yeah. So what's happening is a lot of different things, but to keep it simple as possible, it's basically a supply and demand thing. I mean, I know we haven't had a hurricane here, and I know that's hard for a lot of people to understand, but think about all these big insurance companies that are providing capacity to South Florida. I mean, since Hurricane Irma in 2017, we've had back to back hits, not in South Florida, but in the Gulf Coast states, on the East Coast. We've had numerous hurricanes, we've had tornadoes, we've had wildfires. So natural disasters are basically wreaking havoc for these insurance companies. And now they're pulling back their assets, because if they're going to put out insurance policies and have to pay claims for catastrophic prone areas. Well, they're thinking a lot about doing that. So we have a lot of need here in South Florida. So when that capacity gets restricted and we have fewer and fewer carriers and we have just as much exposure, we have a supply and demand issue. So that's really the simple issue. We also have low interest rates environment where insurance companies don't want to take a lot of risk when they can't make it up on the investment side. So that also plays a key role in why we're in this situation that we're in. The other thing is that if we go back, and I know we have a graph to show it, and we'll talk about it more, but rates have been so competitive from the time 05 hit, when Wilma hit in 05 to really 17, the insurance companies were making a lot of money. We weren't seeing the storms that we're seeing now. And if you look at this chart here, rates were really low. And from 05 until 2017, a lot of carriers were driving rates down. And that's caused a problem, because now that the market is getting harder, those associations that were enjoying those low rates have to be brought up to where the market is now.
Yeah, and unfortunately, this graph ends in 2021. So if you experienced another 20 to 30% increase in 2022, your number's up here well above the 1.2 million mark on this chart. So definitely is the highest rates have ever been kind of going into 2022, which is unfortunate. Several people asked about Surfside. We're all very familiar with the tragedy that occurred last summer. How has that impacted the insurance market?
It's had a great impact on the carriers that are writing here are looking very closely. That they're doing more underwriting now than I've ever seen in the 30 years that I've been in business. It used to be that if the carrier was offering a renewal and the market was competitive, that those carriers, they wanted that business and they wanted that renewal. Now they're looking at everything like it's a brand new account. So where you see there that those 40-year inspection requirements, they're looking at that. They want to make sure that these buildings are sound buildings, and they want to make sure that the association is doing what they're supposed to do because the insurance company is making the assumption that these buildings are in safe and they're in adequate condition. And now they're really making sure, and they're doing a lot of underwriting as policyholders, you're going to need to prove it.
Right. And then there's another issue going on in the marketplace, these Irma roof claims. I think some people are aware of associations that may still have tarps on their roofs, or unit owners and HOAs that still have tarps on their roofs, and they're claiming Irma damage. What has that done to the market?
So it's had also a very big impact on the market. So a lot of communities and a lot of individual homeowners have been approached by roofing contractors and public adjusters and lawyers, and have said, hey, you file a claim with us and we'll get the insurance company to pay for your roof. And even if you don't think you had damage, you got nothing to lose. So a lot of people did that, and insurance companies in some cases had to pay. In many cases had to pay because the insurance company didn't document that the roof was in adequate condition before the storm. And now they're being forced to pay. So we have a rule here in Florida that was passed some years ago that if 25% of the roof is damaged, that the insurance company is required to replace it. And that's being used to the advantage of these solicitors that are able to get new roofs for some homeowners or building owners. And now that these insurance companies have had to pay these claims, I mean, we're 5 years almost from Irma, but there's still thousands of claims that are open that are being litigated. Many of them are being litigated where if the public adjuster or the contractor couldn't get that homeowner or building owner a new roof, they hired a lawyer to sue the insurance company. And I don't think I have to tell you that that's driving up the cost of claims significantly, and it's also deterred the insurance company from writing new policies on buildings that have older roofs.
Right. So that takes us to our next item, which is we're hearing about some condos whose roofs may be between 10 and 20 years old, and they think they have a 30-year roof. The insurance company is telling them maybe the roof's excluded, it's not fully insured. They're only going to insure actual, current depreciated value versus full value. What are you seeing in that arena?
In some cases, if the insurance company has reason to believe that a roof that's like you say in that 10 to 20 years isn't in good condition, then they will put a valuation that's ACV, actual cash value, which is, like you said, it accounts for depreciation. So you're not going to get new for old, you're going to get old for old. And then once you put a big hurricane deductible on top of that kind of valuation, it basically renders your roofs not covered. So that can be a big issue. We're also seeing many companies, Citizens being one. So if a condominium is being canceled by their carrier, and that's very common right now, we're seeing a lot of carriers that are pulling out of Florida, or they're just reducing their capacity, and they non-renew you, and you're forced to go to Citizens or at least look at Citizens. Citizens is going to require a roof inspection for every single building. So A, that can be costly, and B, if you can't have a licensed roofing contractor fill out a form and confirm this, you're not going to get insurance from Citizens or probably any carrier, at least for replacement cost.
Right. So we've talked a lot about property insurance, roofs and Surfside and different things, but liability insurance is a large line item. And for some of our HOA board members and managers on the call, maybe the larger line item. So what are you seeing in the other lines of coverage like liability, D&O, and umbrella, and how are they being impacted?
Unfortunately, it's like the perfect storm for insurance right now. I mean, those three policies that you just mentioned, the association's property, general liability, and umbrella policies, if you add up the sum of premium for those three policies, it's better than 90, probably 95% of what an association pays. So those three lines are being impacted very negatively here in South Florida. And, we talked a lot about the property, but let's just talk about the liability and the umbrella for a moment. If you Google social inflation, you'll see that the cost of claims, the cost to settle claims for slip and falls are on the rise, and they're on the rise significantly. Plaintiff attorneys that file claims know that they can drive a higher claim they can force the insurance companies to pay more money than they've ever paid. And if you're legitimately injured, that's good, but it's going to cost us all more money. We're in a very litigious environment here in South Florida. Most of your callers are probably in South Florida, and it's not a very good environment for an insurance company to be in, because the number of claims that are litigated where there's attorneys involved are very high. I think I shared a statistic a couple of days ago. Since 2013, the insurance industry has paid $15 billion in claims. 71% of that money went to the plaintiff's lawyer. 21% of that money went to the the insurance company's lawyer. So that leaves 8% for the policyholder. So that kind of illustrates right there the environment that we're in and why carriers are raising rates and pulling out of Florida for liability. Umbrella, same thing. It's catastrophic insurance. We just got the Surfside collapse, unfortunately, and a lot of carriers are just saying we're just going to leave altogether because we just don't want to take that risk anymore.
Right. Unfortunate. Very difficult situation right now. So what should people be expecting as they go to renew their insurance in 2022 or Q1 2023? What to expect and what to look for? In terms of valuations, how's that working?
Well, I mean, everybody sees what's going on in the world right now with the rising cost with inflation. So the property insurance policy is very reliant on the amount of insurance that you buy. They charge rates based on and most bylaws require that you insure the full replacement costs. And associations, for the most part, are very diligent about getting appraisals to make sure they're doing that. But the costs are going up so fast that the insurance companies are very concerned that the amounts of insurance that policyholders are buying are not adequate in the current environment. So they're looking at that very, very closely.
Right. So just all other things being equal, even if you got the same insurance rate, but your valuation doubled, your premium would double effectively, right?
That's right.
But we're seeing rates go up by 30%, and then valuations are also going up. So it's kind of, it's a double whammy in terms of how much these policies are increasing.
That's right.
Re-underwriting, you addressed this a little bit earlier, but that's what you mentioned about these insurance companies are looking at every account, even if it's just a renewal with the existing carrier, like a brand new account, right?
That's right. It used to be you could get that. If you were with that company, you were pretty good, and they were pretty happy to renew it. Now, what was before may not be tomorrow because just because they did something yesterday doesn't mean they're going to do it again. So it becomes very, very difficult. And with carriers canceling, it's the same thing. Without a lot of capacity here to find a replacement carrier. That's where we're seeing the steepest increases is if you're being canceled.
Mm-hmm. And then another thing people are seeing is changes in the terms of their insurance. So what are the common things that insurance companies are changing in the policy to try to reduce their risk or save money?
So the big thing is we're seeing those hurricane deductibles. If the association had a 2 or a 3% deductible, they're no longer offering that. So they're going to bump that rate 20, 30%, and they're going to bring that deductible up from 2 or 3% up to 5%. So the association is going to have to take more risk. We're also on the topic of valuations. We're also seeing a co-insurance provision being added to the policy in place of an agreed amount. So what that means is when on the inception of the policy, if your agent was trying to get you the best coverage that he or she could, he or she would negotiate an agreed amount clause. And basically on the onset of the policy, the policyholder and the insurance company agree that the replacement valuation is the right number. The insurance company is happy with it. And the insurance company will waive their right to do an appraisal when there's a loss at the time of a claim. So the last thing you want is the insurance company having the ability to do an appraisal, because a co-insurance clause requires that you insure at least 80, 90, 100% of the replacement cost to be verified when there's a loss. And now that puts additional risk on the table, because if we have a claim and the insurance company does an appraisal and they discover that the association is out of balance on their co-insurance requirement, they now have the ability to invoke a penalty on the amount of the claim that you're going to get. And this is after you're going to pay this tremendous deductible that's probably just been increased.
Right. So we actually have a good example of this, Paul. Let me just flip over to that slide so people can kind of see how the real numbers work. So if you have a co-insurance provision and you originally insured your property for $10 million because that was based on a valuation, maybe that valuation is 2 or 3 years old now, and with inflation, that's just not enough. You have a loss then they determine the property worth $15 million on the reappraisal, like you said, because that's a provision of the contract. The insurance company has a right to reappraise. So then it would, let's say the loss was during a named storm. So it was a hurricane or a tropical storm. So you have a 5% deductible. So right off the bat, you have to pay $500,000. And the loss is figured to be $1 million. So 15 million times, so you need to have had $15 million of insurance, but you didn't. You had insurance based on a valuation of 10 million. So that means you were only 66% insured. So that's how they factor your penalty. So your $1 million loss is put up against that 66% penalty. So the insurance company is telling you, we're really only going to cover $660,000 of that $1 million loss because you weren't fully insured. So, okay, they're going to cover 660,000, but remember, you have a 500,000 deductible. So they take that out first. So you're only going to get paid out $160,000 of that $660,000 loss. So you, without the co-insurance provision, or if you had fully insured the property, but remember, you would have paid a lot more in premium, then you would have had $500,000 paid out on the loss. So the co-insurance provision cost you $340,000 in lost insurance payouts because of the penalty. So it's a little bit complicated. We will give out these slides so people can try and digest that. But the co-insurance provision can be very significant, as you can see here. So kind of going back to some of the different items that we were talking about in 2022, I think you had mentioned, even if your incumbent is renewing, what are the kind of increases that you're seeing?
Minimum 15 to you got on the slide 15 to 30%. Yeah, we're seeing that's at a minimum basis right now. I'd say the average is probably in that 20-25% range, where the incumbent is offering renewal.
And in the event the carrier cancels, is this 50 to 100% still accurate?
Yeah, I think that's a pretty good range. You know, it's also probably good to mention too. A lot of associations we covered, you know, admitted, non-admitted carriers. A lot of non-admitted carriers, if the community has a lot of buildings and it's a big what we call TIV, total insurance value, a lot of those surplus or non-admitted carriers will tower a program or they'll layer a program. So if a community is insured by one of these towers or one of these layered programs, it's going to be likely that these carriers are going to restrict what they're putting out. They're compressing their limits. So it's in effect the same thing as being non-renewed, because we got to go out and fill the capacity that now has been compacted or restricted with new capital, and that's really hard to come by, and it's going to come at a premium. So that's probably, for all intents and purposes, like you're getting non-renewed if you've got one of these tower programs.
Right. So who are the most likely candidates to get non-renewed when they come up? Who is there? I would assume certain types of buildings and certain issues are the ones that are more likely to get non-renewed than others.
Yeah, that's a really good point. The buildings that are more likely to get non-renewed are the older buildings that have older roofs, the buildings that don't have impact glass or opening protections, those buildings that have open claims from Irma. Those are the ones that we're seeing, the ones that have claims as well, not only just open claims from Irma, but like a lot of slip and fall, liability claims. If we've seen a lot of water damage claims where pipe breaks and things like that, or if the carrier does an inspection, we're also seeing these buildings that have electrical panels that are a concern for the insurance company, that were built in the 70s, where they think that there's a fire hazard. Those are the ones that are at most risk.
All right. We talked about co-insurance. So I think on everyone's mind is, how can we reduce rates? And unfortunately, there really aren't any easy answers, but what are some of the things buildings have done to reduce rates in terms of improvements and different things?
So, associations are looking at whatever they can do, because a lot of this boils down to risk modeling. The insurance companies, they heavily rely on artificial intelligence when it comes to, and it really, a lot of the rate load is windstorm insurance. So if we can do things to mitigate that, some communities are really close to getting their community where everybody has opening impact. Maybe there's, just a very small percentage of unit owners that are left, and they were able to convince those unit owners to get shutters or impact glass, and now they're going to be modeled as a fully impact building. That's gonna help your cause. Same thing with newer roofs. If associations are looking at old roofs, then and it's time to replace it. I mean, it's not going to have enough impact where you're going to spend the money to do it, but if you're going to do it anyway, then the modeling has a big impact on it. Controlling your claims is another thing. When we're not talking about property insurance, we're talking about liability. Some communities at our recommendation are putting together safety committees, and they're really focusing and they're working hard to try and reduce the number of incidents, try and make the community a safer place so claims don't happen in the first place.
All right. And again, what improvements have the biggest impact? I think it's definitely going to be the roofs and the the windows and doors. And like you said, it's an all or nothing proposition. You have to be 100% impact glass on the building. If even one owner is holding out, you're not going to get those credits. And those credits are in bigger buildings are six-figure credits.
That's right. It is like you say, in bigger buildings, it has a big impact.
What is the percentage roughly of discount you get if you're totally impact? Do you have an idea?
So, it really depends on the rate, but I would say you could on the property policy, you could conservatively say 10%.
Okay.
And that's very conservative.
Right. I think people have asked, and this goes back to kind of self-insurance, do we need to insure for the full replacement value? And the answer is obviously yes. Your association documents most likely require that. There's elements of the law that require that. And for your own personal risk as a board member, I don't think you want to be under insuring, knowing that you need to be fully insured. And then, just kind of what should people look for when they're evaluating the policy options? They may be presented with a couple of different carriers. Kind of how do you decide between one carrier and another?
I mean, that's where your agent has great value, is helping you make that decision based on experience that the carrier has in paying claims, based on their financial stability, based on their tenure in the market. There are some carriers that have been in this market a long time. We know they're going to be here. We also know who the carriers are that come in and out quickly, and obviously, that has great value. But making sure that you're communicating with your agent, and your agent understands how to write community associations and where to go, that has great value.
So as a board member, kind of how do you communicate this to your residents? You need to do it early and you need to do it often. If you do a monthly newsletter, talk about it at your board meetings. Anytime the board is addressing the community, start making people aware now about the budget increases that are coming maybe later this year if you renew your insurance late in 2022 or in 2023. It's not just insurance. We're seeing inflation across the entire market here in South Florida and the country. Budgets are likely to go up more than they ever have in anyone's kind of recent memory down here in terms of HOA and condo maintenance. So you need to start talking about these things early. People who could have the opportunity to plan and know what's coming are going to be far more understanding than those that get slapped with a massive increase and no warning ahead of time. Have your professionals deliver some of these messages. I think you've all heard Paul speak very eloquently today about the problems in the market. As much as you may try to remember everything that he said, it's far easier to have your agent come and explain to the residents why this policy has gone up so much, how they shop the market, what other options were available in the market, and why those didn't fit your unique circumstance. Your agent should do all of that for you, and it's going to take a lot of pressure off you as a board member. And you don't. Some people like to shoot the messenger. It doesn't have to be you. So let your professionals deliver the message and answer the questions, and you'll look far more intelligent as a board. And at the end of the day, I think something we got to keep in mind is condo property insurance is still a great deal. Yes, it may have gone up 30% over last year, and no one wants to hear that. But if you're living in a beachfront or intercoastal front building, we have one in our portfolio. They have a $1.7 million policy and they have 1,100 units. Well, that's an average cost for property, liability, D&O, fidelity bond. This is their entire package. That's an average cost for all those insurances of only $1,546 per owner to live on the water in South Florida. That is very little compared to what you would have to pay if you owned a single family home in a similar area. You'd be looking at, these numbers are probably a little dated now, you'd be looking at more like $8,000 to $15,000 of insurance as a single family homeowner to live in the same location that these condo owners live in. So do keep in mind when you're explaining to your residents that buying this insurance in bulk the way you are and living in a condo is still a great deal in terms of living on the water down here than some of the alternatives. So with that, we're kind of at the end of our pre-canned material today. So I'm going to try and go through some of the questions and see if we can help those of you in attendance. First question is, Paul, do you do any business in Brevard County?
Yes, we do. Yep.
Okay, so those of you in Brevard County, do not hesitate to reach out to Paul if you're considering him as an agent. Someone asked about a 14-month policy, and then it's going to be a 12-month policy. This is a very specific question. I'm going to say you should talk to your management company or your accountant about how to pay for your 14-month policy. Are any associations converting to self-insurance? I think we addressed that earlier. Self-insurance is not an option for associations. Someone asked for us to provide the list of items for comprehensive coverage again. So can you go through the main lines of insurance that every condo should be carrying again, Paul?
Property insurance, general liability, directors and officers liability, umbrella, crime and fidelity insurance. Those are the traditional standard lines.
All right. Someone asked along those lines, is excess liability the same as an umbrella?
Pretty much, yeah.
And then you had mentioned legal gap insurance. Could you explain that a little bit further?
So yeah, legal gap insurance is fairly a new insurance product, and I think it has a great, it provides a great value. So what happens is if you look at and this is primarily on the liability side, because on liability, it protects you from third-party claims like slip and falls or a management liability, a directors and officers claim. But all those policies have terms, conditions, exclusions, things like mold is excluded, things like communicable disease, that sort of thing. So if you present a claim to the insurance company and they deny it and you're getting sued by somebody, you're still going to have the cost to defend this lawsuit. Well, Legal Gap provides that legal protection, hires a lawyer for you like your insurance company would, but now you're being denied the claim. So it'll pay for the cost of your legal defense when you're sued and not covered by insurance.
This goes back to the roofs. Why are insurance companies saying these roofs need to be replaced after 20 years when a good tile roof can last 30 or 40 years?
Yep, that's a great question. So, we kind of covered it a little bit earlier that these roof contractors and the public adjusters and lawyers have knocked on people's doors and said, we're going to get you a new roof. And even if you don't think you have claim from the hurricane, we'll make the insurance company pay for it. And 9.5 out of 10 times, it's been buildings that have old roofs. So the insurance companies see that that's a great risk to them. And there's a law in Florida that says that if your roof is damaged 25% or more, they got to replace the whole thing. So it puts the insurance company at a disadvantage. They're already losing money. We've had year over year bad storms. So the insurance companies are looking at it like, if we're going to write new business, we're not going to write new business for old buildings. We'll cherry pick. It becomes very, very difficult if you have an old building and you're being canceled to try and find a new insurance company. Like I said, Citizens requires that you do that building, that roof inspection on every single roof. If it doesn't pass, you don't get insurance.
All right. Someone asks about pollution insurance. Is that something you've seen or recommend for associations?
Pollution insurance is something, especially condominiums that have emergency generators where they're holding, diesel fuel perhaps to power those emergency generators. It's very inexpensive insurance and really good value. So I think if there's any kind of exposure to that and you don't have it, you need to talk to your agent. You can buy it for less than $1,000 a year. Highly
marinas too. Do you see that on marinas, Paul?
Yeah. Marinas too.
Yep.
Yep.
All right. Someone says the bylaws require 2 more bids on expensive purchases. Do we have to go to more than one broker? They don't, but explain that a little bit.
So like we kind of covered early on, it's your agent's job to do the bidding. The agent doesn't set the pricing, the insurance companies do. So yes, you should have multiple bids, and your agent should put a proposal together for you that has a summary sheet of all the companies that he or she has been to. And that should satisfy your requirement to get multiple bids, because your agent doesn't set the pricing, the insurance company does. And that's your agent's job, is to help you acquire those bids from those markets and help you explain it and make sure that he or she is putting you in the best position possible to presenting a submission to them so that you get the best result possible.
Right. Someone asked if the HOA had a fall incident, but there was never a claim that resulted from it. Does that incident count against the HOA as far as an increased premium?
Yeah, I mean, any incident, first of all, is unrelated to this question, but whenever there's an incident, you really should report it to the insurance company, because you never know, if you know of an incident, you don't report it, you could be jeopardizing yourself going forward. So I always recommend that you turn in every incident that you know about, that even if it's a minute chance that it could be a claim. But those incidents, if there's no payout and they're closed with zero, have a very little impact on the overall cost of your insurance. And as I said, if you don't report it and it turns into something later, that could have a big impact.
What is the typical useful life you're hearing now that these companies are applying to these roofs?
I mean, the typical life hasn't changed. It's just that the insurance company wants to know that that roof is in adequate condition, because the roof life is the roof life. As you get towards the end of that roof life, carriers are just not interested in writing business. So or they're not interested in writing that business. So that it becomes more of a challenge for that community if they have to change insurance companies. And we have plenty of associations that have older roofs, and they can demonstrate that they've done a great job in maintaining it. The insurance company will renew it. They'll give us replacement costs, and we don't have any issues. That goes on every day. It's just sometimes they do drone inspections, or they send somebody over there for a physical inspection, satellite imagery, and they get the impression that there's a problem. You better be able to demonstrate it, because they're going to take they're not going to take the benefit of a doubt anymore. They're re-underwriting everything. They don't want risks that they think may come back to haunt them if they don't have to.
So are there any statutes that prevent the massive increases in insurance or declines or anything like that?
Well, I mean, rates were so depressed to begin with. I mean, that's sort of a problem, but the short answer is no. We talked about admitted and non-admitted carriers, and the non-admitted carriers, they don't have to get rates approved. So there's going to be a special session. The governor announced last week, and we'll see what they come up with. But I think that if they start telling insurance companies they can't raise rates, we're not going to have any insurance companies here. So I think that the regulators and the lawmakers have a very tough job ahead of them.
All right. So will the insurance company accept an engineer's inspection report that the roofs are in good condition? Will that help?
An engineer, a licensed roofing contractor, they're going to demand that you demonstrate that these roofs are in good shape. The forms that I see are generally licensed roofing contractors or licensed general contractors. And there's a standard form, a one-page form that citizens and most private insurance companies want to see filled out and verified.
Someone mentioned that boiler and machinery was not mentioned as a coverage, but that is a common one for condos. And also law and ordinance is another one I know that.
Yep, built a lot of times the boiler machinery or equipment breakdown is built into the property policy, so it's not a separate policy, and sometimes it is a separate policy. Law and ordinance is an endorsement onto the property policy, and it's really important to have, very important to have.
My insurance is canceled. How long should it take to get a quote for new insurance?
The more time you give your agent, the better probably the result will be, because a lot of these carriers are holding the capacity till the 11th hour because they only put so much out there. And if it's out there and they don't know if they're gonna use it, they won't respond. And sometimes you can find a company that's willing to put out some capacity at a better rate than what you've been offered. So, what I do with my clients is I communicate with them very clearly along the way. If their renewal is on May 1st, we'll talk the beginning of April, give them an update where we are. I'll give them an update of where we are in the middle of April. And I say, if I have to pull the trigger right now, we're looking at a 40, 50% increase. You're just picking a number. But if we wait another week, I'm hoping that's going to come down maybe another 5, 10%. So it's not like we wait till the 11th and a half hour and I'm giving you a number that you have no idea what's coming. Communication is the key. Dealing with an insurance agent that understands this market, has the connections, and knows how to manage expectations is probably the greatest value you'll get out of your agent in this environment.
Someone asked how an HOA could save on insurance. The answer to that, it depends on type of HOA, it depends on what other common property you have. But liability is often a bigger component of a lot of HOAs than the actual property policy. So you really want to be careful about your sidewalks and potential slip and fall hazards. We're seeing a huge uptick in these sidewalk lawsuits. If you have oak trees and other things pushing up those slabs, you need to address that. The best thing you can do is just keep your claims down in an HOA, because that's what really drives the liability rates. Anything to add there, Paul?
Yeah, I think you hit it spot on. Doing whatever you can to create a safety committee, engage the people in the community to help, regular inspections and doing those sort of things, looking at your claims that you have experienced and seeing what you can do to curb them from happening again.
Have you seen roof coverage going from RCV to ACV, so that's replacement, to actual cash, and has that impacted unit owners and their lenders?
Yes. So, it's happening. It's not the norm. So it's not that every single building is going to be renewed that way, but we do see, if you get canceled and you got old roofs, that carriers will say, we'll write this, but we're going to write it on ACV. And so the answer to that is yes. And in some cases it will impact a lender. It's not the norm. It doesn't happen every day, but we'll see a situation where a lender, some of these lenders that have adopted very strict practices when it comes to insurance, won't accept it. So fortunately they're far and few, but it does happen.
Can you talk more about EFIS and its impact on rates? That was on one of the slides. We didn't really address it. Well, first off, what is EFIS and how does that affect rates?
Yep. EFIS, or private construction. EFIS is an exterior finish. It was common in the 80s, and it historically does not hold up well when it comes to water damage. So if you get a lot of rain and wind events, water will penetrate onto the inside of the building. Insurance companies very, very much dislike this EFIS exterior construction, and many carriers will exclude or won't write it all together. So if you have an EFIS building, it's likely you're going to have compounding problems, or your rate's going to be higher to start with.
So we have someone on from the Orlando area. Do you do business up in the Orlando area, Paul?
Yep. We have offices in Brevard and Orlando. We have 450 offices all over the country. So we can handle communities just about anywhere.
Great. So don't hesitate to reach out to Paul. Is there a difference in premium reduction depending on your roof type? In other words, an asphalt versus tile versus a metal roof. Do you get any discounts?
Yeah, well, I wouldn't say it's a discount, but your rate's going to be lower to begin with, because your building is going to have a classification it's kind of a standard. When your agent puts the submission together, the carriers, you're going to be a class 1, 2, 3, 4, or a 5. And if the building is of wood construction, you're going to be a class 1. If the building is all concrete and steel and no wood in the roof deck, then you're going to be a 4 or a 5. So the rates for one are obviously higher than the rates for a 4 or a 5. So it's not a discount, but your rate's lower to begin with.
Someone asked, how much power does the agent have in negotiating lower premium with the insurer?
The market's really hard right now. So, I'd be wary of an agent that comes in and says, well, I'm going to cut your costs or I'm going to do this. But the real value that an agent has is his or her ability to reach out to these underwriters, get them to do things that they might be a little uncomfortable doing, communicating with you, the insureds, the points that Evan made, use those professionals to go out there and help you deliver these messages. And it's important because you go out there with a building that has an older roof, and if you don't have the right connections, it could be a challenge to get it placed all together. So that has tremendous value. But I would be very leery of an agent that comes in and says, "Oh, hey, I'm going to save you money in this market. I'm going to do a better job," because it's the insurance company's market right now.
All right. Someone asks, is it possible to get a GL policy that lasts longer than 12 months?
I mean, anything's possible. If you're going to try and get a longer term policy, it'd be easier to get right now with the liability lines than the property. So short answer is yes, you could probably get that done on liability with non-standard carriers, with non-admitted carriers. With admitted carriers, no, because they're not filed to do that.
Right. A lot of associations have websites. Are you recommending cyber for your clients?
Yes, that's a great point. And I probably should have spent a little more time covering some of those policies as well. But cyber insurance is super cheap. You can buy a policy for as little as $300 a year. The most expensive one that has a lot more comprehensive coverage is like $900 a year, and it covers your cyber exposure if there's ever a data breach, if there's ever a breach of personal identifiable information. Great value and a real cheap premium.
Right. I'm probably a little bit premature for this, but someone's already asking about a 2023 forecast for insurance budgeting. What advice would you give them?
Well, I'm trying to get through 2022, but I think a lot will be dependent on what happens in this special session when they meet. I think a lot will happen. What happens with this hurricane season? What happens with interest rates? So I think keep your eye on those three things. And I think as we get closer to the end of the year, that question will come into focus a little more.
All right. Someone's asking, any idea about what the legislature might try to do related to insurance?
I think one of the things that they tried to do this session that failed was deal with these roof claims and deal with the 25% rule. They wanted to limit how these roofing contractors could solicit people, and that's at least what the insurance industry was recommending. So if they pick up where those proposed bills that failed left off, that's probably some of the things that they'll address. But what they've got to do is they've got to create an environment where we're going to have more capacity here in the market. Otherwise, after Wilma, the lawmakers just decided to take all the risk in Citizens, and they highly subsidized those rates. It was a quick fix overnight, but Citizens blew up. And the state had all this risk that they weren't insured for. So, then what happens? We all, as citizens, and we all end up paying for that some way, somehow. So, I don't think the current administration is going to look at doing that, but I think they've got to somehow create a competitive environment, because that's what we did last time after Wilma. We created a very competitive environment. Fortunately for us, we didn't have any disasters, and that's changed since then. So I don't know if they're going to, it's not going to be as easy as it was back then.
All right. Do you recommend terrorism coverage be included?
Yeah, terrorism coverage, generally, they got offered the TRIA as they call it. I think when you're dealing with non-admitted carriers, you could look at it to see what it is. But most associations, I would say better than half, do buy the terrorism coverage. But one way to cut costs, as long as you're comfortable knowing what risk you're taking, because a lot of associations want to do that. A lot of associations want to say, how can we save money? We can't afford this premium. What can we do? So as long as you're aware that you're taking on risks that you weren't taking on before, and you're okay with that, it's something to consider. Okay.
What is the earliest an association can expect to at least get an estimate for an upcoming renewal?
Well, that's really going to depend on your agent. So I've got some that I've done now. What's today? Today is the 18th of April. I've got some of my beginning of May renewals that are done already. So that's pretty good in this market. But those that are a bit more of a challenge, the greatest value your agent has is the way he or she communicates with you. Because if you don't know what's going on, and then at the 11th and a half hour, you get hit with a 50 or 60% rate increase or even more, and you had no idea that was coming, then that hurts. But if he or she communicates with you along the way and keeps you updated and lets you know, hey, we're here right now, maybe it's going to get a little bit better, then at least you have an expectation level to manage. And I don't think in any cases you're going to get anything in this market that's more than 30 to 45 days ahead of the renewal. And in some cases, it makes a lot of sense to wait until the 11th hour because there's some capacity out there that we might be able to take advantage of. But, finding out the day before your renewal that you're getting a 70% rate increase is really unacceptable, in my opinion.
Quick one here. Are agent and broker interchangeable terms? I think you and I have both been using them interchangeably today.
Yeah.
Yes,
they are.
Yeah.
For terms.
Right. What is the effect of the new FEMA flood maps on insurance? Are you seeing anything there?
Yeah. So FEMA went to a new rating system. They call it 2.0. And in some cases, it has saved policyholders money. So now that we're in April, it's pretty automatic. But great question to ask. If you're in a high hazard flood zone and you're buying FEMA flood insurance, you want to make sure that you're using that FEMA is using the 2.0 rating system. There's another round of map amendments coming for South Florida. When, we don't know. I think COVID has delayed that further, but because the artificial intelligence has improved so much since the last time they did it, I'm going to say 7-8 years ago, they feel like they can more accurately predict risk. So another round's coming. That means that some of us are going to experience, we're no longer in a high hazard zone, and vice versa. Some of us that are in a low hazard zone are going to go into a high hazard zone. So that will be coming at some point. We don't know.
Okay. Does it reflect poorly on an association if they try to change their insurance agent? Will have any impact on rates?
I mean, there should be a good reason why you're changing insurance agents. I see too often that an agent of record letter is changed because the association thinks that they're going to get another bid, and that does not make underwriters happy. I think that does make. But if you want to change your agent because you have higher confidence in somebody else, or you're not getting the service, or they're not doing the communication, and it makes a lot of sense, that's okay. You just can't be throwing this letter around all the time thinking that you're getting bids. That does not make underwriters happy. It makes them do more work that they don't have to do.
A couple of people have asked about, is this going to be available online afterwards to view? Yes, you can find this video at campbellevents.org, and you can find it on our YouTube page. If you want to watch this, or forward the link to any of your fellow board members who maybe couldn't join us today. So at this point, we're right up against 1 o'clock. We tried to get to as many questions as we could, but we do want to be respectful of everybody's time, including Paul. So Paul, any final parting words for us this afternoon?
I think we covered a lot of things here, and if I can help anybody, you put my contact information up there. It is a very difficult market, and I hope that everybody found this information useful and made them a little bit better of a consumer. So thanks for everybody's time, and thanks, Evan, for including me.
Great, thanks a lot, Paul. Very informative. A lot to digest. A few people did ask about co-insurance. Again, I would say just review the slide that we presented. It'll be emailed to you. That's probably the best way to understand it. It is a little complicated. So with that, I would say thank you all for coming. We hope to see you at another webinar here in the near future. Again, campbellevents.org is where you can find all of our upcoming webinars. You can subscribe to our newsletter, which will let you know how to register for upcoming webinars to view live. And if you want to see any of our blog articles, that they'll be there as well. So again, thank you for coming. Hope to see you in the future. Have a great rest of your afternoon. Thanks, everyone.